You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have J D Wetherspoons, Savills, Carnival, Boohoo, Prudential, and our tech company of the week is Trustpilot, if you can call it that. Sam, shall I kick us off with J D Wetherspoons?
Absolutely. How are they doing?
They're doing pretty well. It's certainly a tough environment. They had their half-year results out, with the group reporting half-year revenue of £1 billion, reflecting like-for-like growth of 4.8%. Underlying operating profit fell by 4.3% to £64.8 million, mainly due to the increased labour and utility costs. Free cash outflows improved from 6.1 to around £500,000, with improved cash generation in the business more than offsetting an increase in capital expenditure. Net debt after lease liabilities was stable at £1.1 billion. J D Wetherspoon reiterated its labour cost concerns, which amount to a forthcoming additional annual cost of £60 million, approximately £1,500 per pub per week. Like-for-like sales growth in the first 7 weeks of the second half was 5%, and the company declared a dividend of 4p a share. No interim dividend was paid last year. Also purchased or repurchased around £11.5 million of shares during the period, and the shares were down around 11% in early trading. In terms of valuation, the group has a market cap of £650 million and trades at 11.3 times forward earnings, compared with a 10-year average of 20, and it has a prospective dividend yield of 2%. I suppose it depends how you look at this. I mean, it's certainly encouraging that revenue's up nearly 5%, and, on the surface of it, recovery from COVID is going in the right direction. But it's got so many headwinds, and they have alluded, to them. They mentioned the labour cost concerns, and obviously the inflationary backdrop with increase in utilities as well. I really wouldn't go near J D Wetherspoons at the moment. I think the increased regulation, national insurance rises, energy, alcohol duty, and then all of that combined with Gen Z drinking a lot less, I think that's a pretty toxic or pretty difficult combination for the group. I just wouldn't be optimistic about it. I mean, I think they're in a relatively strong position in that they own a lot of the pubs in the chain. But with those increased costs coming down and people in general drinking less, I just couldn't make an investment case for Wetherspoons, I don't think. Sam, what are your thoughts on these results from Wetherspoons and the future?
I thought the results were pretty good, all things considered, but as you've said, the issue is looking forward. I think the results just put up are pretty decent, but then operating profit, £64 million for the half, and they have estimated, as you said, the costs of the various labour changes in terms of minimum wage and NI. That has been estimated at £60 million. So if we take that first half operating profit of £64 million and double it, basically 50% of the profit is now gone from that. Just wiped out.
Yeah.
And like you say, that's assuming there's nothing else in the future that makes things even worse for it. At least it does own most of its buildings, so it does have a strong balance sheet, but it's hard to be optimistic about it. It's not a business I'd feel comfortable owning for 20 years, I think, unless maybe there was some argument they're going to unlock the value of the balance sheet by just selling off all the buildings. But in terms of the actual business as it continues to run, there's a lot to be concerned about, and I don't think that's been helped by the minimum wage and NI changes.
Yeah, and I think, anecdotally, when you go into a Wetherspoons, you do have a lot of young staff, probably between 18 and 21. So if minimum wage has been hiked, it's about 16% in that age group.
It's a lot. I don't know if it's top of my head.
It's not good. Not good news for J D Wetherspoons, I should say. Fine. Shall we move on to Savills? Is it a debut on the show?
I think it is, yes. So Savills So I wanted to cover these because I deal with them occasionally at work because they do kind of property management and they'll look after your properties for you basically. So occasionally I deal with a client that has their properties managed by Savills. So because I interact with them, that was the main reason I was curious. So for anyone who's not familiar with Savills, they were established in 1855 and they are one of the leading real estate advisors in the world. Their range, and this is from their website, so take it with a pinch of salt, but their range of expertise covers all the key segments of residential, office, industrial, retail, leisure, healthcare, rural and hotel property, and also mixed-use development schemes. They have over 700 offices and associates and over 40,000 staff throughout the Americas, UK, continental Europe, Asia-Pacific, Africa and the Middle East. In terms of the services they provide, so they provide asset management, where they will help clients develop strategy, create framework for decision-making, and appraise properties. They have a buying and selling business, so they will advise on all residential, rural, and commercial markets. Consultancy business, where they draw on industry knowledge, experience, and market trends to deliver bespoke advice. They will help you with development, from valuation, land sales, and acquisitions to funding and portfolio support. They'll help with finance. They'll help choose investments in property. They will act as agents in terms of letting something out. They will help you if you need to obtain planning permission on something. They will help you if you need a valuation. Basically, anything you can think of that involves a property, they are probably able to do. So they have come out with their full year results, and revenue was up 7% to 2.4 billion. Underlying profit before tax was up 38% to 130.4 million. Reported profit before tax was up 59% to 88.3 million. Underlying basic earnings per share was up 20% to 66.2p a share, and reported basic earnings per share was up 31% to 39.4p. The total dividend per share was up 32%, and the net cash position has improved by 12% to 176 million. They said the good revenue growth was due to strong performance from global transactional advisory, with revenues up 13% for that segment, and global residential revenues increased by 6%. They've highlighted good performance from consultancy and property and facilities management, which grew revenues by 8% and 5% respectively. Investment management revenue decreased 11% as anticipated, and they've said assets under management decreased slightly to 21.7 billion, down from 22.1 billion, as the effect of new capital raise was outweighed by valuation adjustments during the period. So in terms of their revenue over the past 10 years, it has grown at a compound annual growth rate of 8.3%, and their transactional revenue has grown at a compound annual growth rate of 5.8%, and the revenue excluding the transactional revenue, which will probably ebb and flow a bit more, that has grown at a compound annual growth rate of 10.1%. So I think those figures are pretty excellent, actually. And in terms of the revenue per region, UK was up 7%, Asia Pacific was up 7%, North America was up 7%, and CEME was up 10%. In terms of the valuation, the business trades at a PE ratio of 15 and has a dividend yield of 2.21%, and the market cap is 1.33 billion. I think these results are pretty good. And I think when you then look at how they've managed to grow the business over the past 10 years, those compound growth rates are also pretty good. I think what I struggle with this business is because if it can continue growing revenue at that rate, and it does seem to be a very, very high quality business, I think a PE of 15 and 2% dividend as well, I think is pretty good. I think what I struggle with is because they are already massive, I think they're pretty saturated in the UK. I appreciate it's probably a very fragmented market, but you hear a lot of businesses that talk about how fragmented markets are, and it's actually very, very difficult to really make much headway into that. A lot of markets that are fragmented tend to be fragmented for a reason, I think. But I think these results are excellent, but I'd question their ability to keep growing at the current rate. And that's not to say they can't do it, but I just don't feel like I have that understanding of the business to assess it. You might argue that at a PE of 15, the risk isn't huge and the market's maybe not expecting them to grow at 10% a year for the next 10 years. But that would just be a concern. But I think it's probably a business I would come and look at again in 6 to 12 months, actually, because it does look like a quality business. What about you, John?
Yeah, I thought the results were certainly very decent. I think it is still, a very competitive industry, and there are lots of other big players there. For me, I think it would be more a case of researching the industry and having a look at some of those big players. And as you say, if the market is very fragmented, why that is the case. And also probably digging into a little bit more that geographical spread that you mentioned, because I think that is quite interesting. I know it's got sort of presence in China and Hong Kong and the US too. So yeah, I think it's definitely one to come back to, but it looks very well run and, as you said before, decent figures.
Should we move on to a business that in recent years have not put up as decent figures?
Yeah, I mean, it's been a very challenging time for Carnival. It's the cruise company. Obviously, we had COVID, almost exactly 5 years ago now. It owns its own brands, of Carnival itself, but also P&O, Cunard's, Princess, and a number of other brands within that wider portfolio. I think it's the biggest cruising company in the world, actually. It's got a market cap of nearly £20 billion. Anyway, they had their first quarter results out with first quarter revenue up 7.5% to $5.8 billion, driven by increases in both ticket sales and onboard revenue. Operating profit nearly doubled to $500 million, helped by tight control of costs and lower fuel expenses. Free cash flow came in at around $300 million, compared with an outflow of around $400 million, reflecting lower levels of capital expenditure. Net debt came in at $26.2 billion, down from $26.3 billion at the end of last year. The outlook for pricing has strengthened since December, and the company has raised its underlying cash profit guidance, expecting nearly 10% growth to around $6.7 billion for the year. And the shares were down around 2% on the results. In terms of valuation, the group has a market cap of £19 billion and trades at 0.1 times forward price to sales, compared with a 10-year average of 0.34. And it has a huge amount of debt, as I mentioned before, $26 billion, and unsurprisingly, doesn't pay a dividend. I thought these results were pretty decent, but I think it's been an incredibly difficult time for them after COVID, when essentially everything shut down, and they're recovering well from it, but you've still left with that headache in terms of the amount of debt that they're carrying from that period. And I think the industry, even pre-COVID, was pretty unattractive. It's, I think, a very cyclical business, requires a lot of capital expenditure. There are all of those variables in terms of fuel costs. So it's one that I would have stayed away from in the first place. But certainly after COVID and with the hangover from that, I'd definitely be staying away. I think they are doing a good job, that being said, in the recovery though, and these are encouraging numbers for the business. Sam, what are your thoughts on Carnival?
Pretty similar. I'll start by saying that I wouldn't touch it with a barge pole.
Okay.
But so they've said that net debt is now $26.2 billion, which is 3.9 times underlying cash profits, EBITDA. But then the problem is the EBITDA is earnings before interest, as well as stuff like depreciation and amortization. But when you look at the operating profit, which sort of reflects all these costs, like the interest, which is a very real cost that they have to pay every year because of all that debt, you've got an operating profit for the full year of $500 million. So when you compare that to the net debt of $26 billion, it's like, well, yeah, in terms of EBITDA, it might look okay, but it's 52 times the operating profit, which is at a level that is just so beyond uninvestable. Now, in fairness, I think they've actually done quite well to get to the position they're in. And I think because COVID was an absolute disaster for them, I think operationally they've weathered the storm, and you have to give credit to management. But, and we said it before, when operating profit's $500 million and the net debt is $26 billion, I just think, well, who owns the business? Because it's not the shareholders, it's the debt holders. And I think although management has to be given credit for doing an incredible job weathering the storm, because I did expect this company to have probably gone bust by now with that amount of debt. And then, record revenues, probably going to benefit from an aging population, but there's the problem is you're going from a starting point where it's just uninvestable because of the debt. I don't think it'd be that investable anyway because it's so capital intensive. But yeah, really, really good job by management. Really good set of results given the circumstances. But kind of through no fault of the company's own, it's uninvestable.
Okay. Are we moving on to another uninvestable company?
Well, it wasn't for us, was it?
Well, neither of us own it any longer.
But both of us did. So Boohoo, a formerly investable company, have come out with their full year results, and full year revenue declined 16% to 1.2 billion, which is below the 1.3 billion that was expected, with youth brands and Karen Millen divisions underperforming. However, the Debenhams division delivered revenue growth of 10% to 205 million, and that was supported by its digital marketplace-led business model. Net debt improved from 95 to 82 million, and underlying cash profit is expected to be around 40 million. Boohoo has announced plans to rebrand itself as Debenhams Group, subject to a shareholder vote, and the shares fell in early trading. Despite only contributing 17% of group revenue, Debenhams actually brought in more than half of the cash profits. And they've also been trimming a lot of costs, with admin, distribution and marketing all down double-digit rates. And they have now exceeded the cost savings target of 125 million they set a couple of years ago. In terms of valuation, there are no earnings, despite the cost cutting. Business trades at a forward price to sales ratio of 0.28, and that compares to a 10-year average of 1.79. I think for a business this established, price to sales is pretty useless, but in the absence of earnings, it's kind of all you've got. I wouldn't take historic earnings and normalize them because I have serious doubts about its ability to get back to where it was a few years ago, and it doesn't pay a dividend. I think this is a continuation of a trend that we were pretty poor at anticipating and slow to react to, flatteringly. But yeah, I mean, we used to talk about this when we've talked about it on previous episodes, but I actually, didn't learn from losing half my money years ago when I invested in Debenhams, and then made the same mistake with Boohoo. And if I hadn't sold it, I'd have ended up with Debenhams again. Of course, I technically did because it was in the portfolio, but it's not a business I want to own twice. So yeah, it's a business that's kind of lost its way. I think a lot of it's kind of trends, really, because I think neither of us really shopped on it at all, and the growth rates it was putting up were fantastic. And I think now, the market's kind of changed a bit. I think that fast fashion market has kind of partly gone away, but then also I think there's the issue you've got businesses like Shein and stuff where it's like if your USP is that you're the lowest cost competitor, if someone else comes in and does it cheaper, you're in serious trouble. And I think although the Debenhams brand was a smart acquisition, the fact that they're rebranding to it kind of shows how far away they've moved from sort of, because Boohoo was kind of a sort of popular brand with sort of people in the 20s and 30s, whereas Debenhams, it's the sort of place your mother or your gran might go. And I think the fact that they're rebranding to that kind of shows just how difficult the market is for them at present. But I wouldn't consider reinvesting into this. What about you, John?
No, I wouldn't. And I think, as you say, what we'd seen was sort of post-COVID, and they were still growing. This is Boohoo, still growing revenue. There was huge demand still. And then the valuation had been falling. And I don't think we thought, well, why is the market reacting like that? And I think in the US, they were building new warehouses and they just couldn't service the demand. So you thought, well, that's a good sign. The market must be getting it wrong. And then I think that trend was partly going on that people were switching to Shein and Temu. And neither of us used the business. We weren't customers of it. And I think that was probably, where we missed things because we hadn't seen that coming. And, purely looking at figures coming out of things, we thought, well, the market's perhaps getting that wrong rather than that shift. And as we weren't customers, we didn't see that happening until it was too late. And then, the share price never recovered. And you've seen it reflected in the results time after time. And it just doesn't look like it's ever going to get back to what it was. And I think that's a permanent thing now. So we both sold our shares and we've taken a cold bath. So yeah, However, had we spoken to our girlfriends, I think they would have probably told us that they didn't shop on Boohoo or hadn't shopped on Boohoo for a number of years because they and their friends had moved to other platforms.
We were obviously wrong, but it was a weird one because I think it kind of shows the warning of these high growth businesses, because for years it grew 20 to 40% revenue like clockwork, and it was one of those businesses that just always seemed to trade at 50 times earnings. So then it had a bit of a wobble just after COVID. Like you say, we thought, well, COVID demand's pulled forward. People are returning stuff they bought in COVID. It seems pretty reasonable. So now at 15, 20 times earnings for the first time in 10 years, what a great opportunity. And then now there are no earnings.
Yeah, that's right. Anyway, lesson learned. You win some, you lose some.
You do. Shall we move on to Prudential then?
Yes.
Business with earnings.
Yeah, it's a business with earnings. It's the Asian-focused insurer. It is one that I used to own until last month. It was part of what I kind of considered my legacy portfolio. They had their full year results out last week, with the group reporting full year annual premium equivalent APE sales of $6.2 billion, up 7% when ignoring currency moves. Underlying operating profit rose 10% to $3.1 billion, and both insurance and the asset management divisions contributed to growth. Funds under management at the asset manager East Spring rose 9% to $258 billion, driven by positive market moves and net inflows. The free surplus ratio, its preferred measure of balance sheet strength, was 234% at the end of the year, and that was above the 175 to 200% target range. A second interim dividend of 16.29 cents per share was approved, taking the annual total to 23.13 cents a share, which is up 13%. And around half of the ongoing $2 billion share buyback has been actioned, with the remainder now expected to be completed by the end of the year, previously mid-2026. For 2025, underlying operating profit and the dividend are expected to rise by at least 10%. And the share price was up around 1% in early trading. In terms of valuation, Prudential has a market cap of £21 billion and trades at 9.7 times forward earnings, compared to the 10-year average of 10, with a prospective dividend yield of 2.5%. I thought these results were pretty good. Part of the reason that I had sold is it's a business that I have no expertise in and I think is quite difficult to understand. We've said that, historically about quite a lot of the banks and insurance companies, but that being said, and that sort of caveat, decent set of results. I don't think the valuation is particularly expensive. It has been held back over the last few years with the slower growth from China, and it has pivoted much more towards the Chinese market and emerging markets in general. It did have more mature Western businesses, so it had Jackson, which it spun out, and that was sort of its US division. And that was, again, shareholders got shares in Jackson as a result of that. And they also spun out M&G, which was the part of the UK asset management business, which again, shareholders got a chunk of. And then it's also mentioned spinning out some of its Indian, I believe, asset management business. And that has given the share price a bit of a boost. I suppose if you're looking for something that is more growth orientated in the sort of insurance business, and you're looking at the UK market, it's available to buy in the UK, then I suppose that's where Prudential probably sits in terms of the investment case for it. And arguably it has more of a growth focus now that it is pivoted towards China. But that is depending a lot on the Chinese economy. So if you do have growth like we had sort of 10, 15 years ago from China, then I think Prudential will do very well. But over the past probably 5 or so years, when things really have slowed down, then you've seen that in the Prudential numbers, and it's probably been underperforming over that time. It's obviously, as I've sold it, it's not one for me longer term, and that's largely because it's not an industry I properly understand. I think you could probably do a lot worse, though, on the surface of it from my limited understanding. But as I say, not one for me anymore. Sam, what are your thoughts on Prudential and these half-year results?
I think the results were pretty good. I think given the size of it, I think to grow revenue 7%, pretty good. Funds under management up 9%, that's pretty good. I appreciate they always get a boost if markets do well. So, and depending on exactly when the year end is, they might have cut it off at quite a good point, given how they've done the last couple of months. But yeah, I think it looks like a good set of results, especially given the size of the business. I think it's quite a nice way to maybe get some exposure to maybe like Asia in your portfolio, but in a lower risk way, given the size of the business. And I think the valuation seems pretty reasonable actually as well, at under 10 times earnings. My issue is, like the same as you, I struggle with insurers. I could easily be missing something, and the problem with an insurer is if you miss something and they get something wrong, it can be a very, very expensive mistake. So I just steer clear of them. They just go in the too hard pile, but based on the results, it looks like it's a well-run business, and I think they've had a pretty decent year.
No, that's right. And I suppose one of the structural things in these emerging markets is there's a lot less in the way of social security. You've got that growing middle class, you've got the growing economy. People are going to want insurance products. And I guess it's companies like Prudential that are there to benefit. Well, provide the service, but benefit ultimately if they get it right.
Yeah, and I think if he's put up these kind of figures and China's not bombing away at the moment, that's pretty good, because I know we're saying in the last sort of 5 years that's slowed down, but I guess it's kind of priced as if anything like that is a bonus anyway. It's not dependent on it at that kind of valuation.
Yeah, no, absolutely. Absolutely.
The only thing is I think if they're focusing on Asia as a continent, I'm not entirely sure I see any benefit in spinning out the Indian business.
Yeah.
Unless they would be delisting it so that, like, you know what I mean? So that shareholders can keep holding it rather than just selling it or something to unlock the value. But I'd want to carry on owning that if I was a shareholder.
Yeah. Okay. On to our final company of the week then, Sam. How are Trustpilot doing?
Yes, so Trustpilot, as with last week, not a US company again. I think we will probably go back at some point. But again, there was just 6 British companies we wanted to cover. So Trustpilot, it is a business we've covered before. It's probably a business that everyone's familiar with anyway, but they are the review website. They have come out with their full year results, and bookings were up 21% to 239 million. Revenue was up 18% to 210 million. Adjusted EBITDA was up 55%, and operating profit was up 716% to 24 and 3.8 million respectively. And the adjusted EBITDA margin was up from 8.8 to 11.4%. Profit before tax was up 367%, and basic earnings per share was down 12% to 1.5p a share. Diluted earnings per share was down 13%. Operating cash flow was up 41% to 29 million, and adjusted free cash flow was up 24% to 17 million. Cash and cash equivalents was down 25% to 68.9 million. And they've highlighted that simplified packages and pricing combined with product innovation underpinned the bookings growth of 21%. And they've improved the last 12 months net dollar retention rates from 99 to 103%. They said they've experienced momentum in network effects and enhanced consumer experience, resulting in reviews up 23% for the year, with 140 billion annual Trustbox impressions. And they've highlighted their strong cash generation with a £20 million continuation of the share buyback program. They've said on the back of the strong 2024 bookings, they expect high teens 2025 revenue growth, so similar to what they've just put up on a constant currency basis, with adjusted EBITDA slightly ahead of market expectations and a 2% improvement in the margin. So that's quite interesting. As the business is getting bigger, the margin is getting better. In terms of the revenue split, it's quite nicely geographically diversified. So of the 210 million revenue, 85 million is UK, 81 million is Europe and rest of the world, and 44 million is US. And that US revenue is growing at 19% a year in constant currency. But then the other two are growing at 18% anyway. So it's still quite a nice growth rate. In terms of the KPIs, or these are the former KPIs, so they've said they're not going to put these up anymore, but number of reviewed domains was up 16%, number of claimed domains was up 24%, number of active domains was up 9%, total cumulative reviews was up 23%, and the number of monthly unique users was up 12%. So in terms of the valuation, the business trades at a PE of 198, price to free cash flow of 55, a price to operating cash flow of 32, and the market cap is 940 million. In terms of the share price, it is down quite a bit from its peak. It peaked at 360p a couple of months ago. It is now down at 230p, but it's still up for the year quite significantly. So its year low was 173p. Over 2 years, it's up 148%. And over 3 years, it's up 42%. So it's still a business that is not cheaply valued. In terms of why the market's reacted so negatively to what on the surface appears to be an excellent set of results, it is mainly, I think, because of the US revenue. Since 2015, I think the revenue had been compounding at 30% per year, and that has now dropped. And I think what's probably more concerning is that the US revenue is kind of dropping in line with that, and that's probably where they're pinning their hopes for the growth. But I think this is a quality business. I think that's shown by the fact that as the revenue goes up, the margins are getting better. It's a business that is getting more and more profitable as it gets bigger, just because a lot of those costs are fixed rather than variable. It's a business I would back to continue to do well. I wouldn't be too unhappy with 18%, 19% growth a year. I could certainly stomach it as a shareholder. I think the issue is that this is one of the most expensive stocks probably on the FTSE. We often talk about how businesses will trade at silly valuations in the US compared to the UK. This is not one of those businesses. I think because it's been one of the few tech stocks that's been putting up the numbers, I think the market's probably gotten a bit ahead of itself in terms of the valuation, because it is just at a level where it's very difficult to value anyway. But you'd be paying 55 times free cash flow for a business that's growing 19% a year. I know it doesn't have to do it too many times before that price free cash flow comes down, especially if the margins are getting better as it's getting bigger. But I still actually think it looks quite pricey. It's a business I would love to own, actually. I think it's a fantastic business, but at this valuation, it's just not really. I just wouldn't be willing to pay it. What about you, John?
Yeah, I mean, I'd agree with you. I think it's a very exciting business. I guess the excitement is reflected in that valuation, and particularly if growth continues in the less penetrated areas like the States, it could be absolutely phenomenal. And it doesn't have a very big market cap, but I appreciate valuation-wise, it's expensive. So, yeah, I probably wouldn't be brave enough to pull the trigger on it, but I think it'd be an exciting one and a UK success story.
So, in that case, of the 6 businesses we've discussed this week, Spoons, Savills, Carnival, Boohoo, Prudential, and Trustpilot, which do you like the most and which do you like the least?
Oh, gosh, it's a tricky one. I'd probably go for... I mean, this would be caveated. I'd need to do some more research, but I'd be interested potentially in Savills of the selection. I think Prudential would probably be a close second. I think Trustpilot, definitely the most exciting, but with my own money, I'm not sure I'd be brave enough to pay up for it. And last, what would be last? It'd probably be Carnival, but I don't like Boohoo, and I think Spoons is going to have an incredibly difficult time too.
I think without sounding boring, I would pretty much echo that. Yeah, so number 1 would be Savills. I think Trustpilot's probably the best business, but it's just a valuation. And then last, most other weeks, unless we're covering an airline, I'd expect it to be Boohoo, but unfortunately Carnival probably has to come last. And I do feel a bit bad for Carnival because I think management are doing a good job, but it is just uninvestable through no fault of its own.
Yeah. Okay. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.